Welcome back. It is time for the Word on Wall Street. Top investors watching your money. Joining me now is Banrion Capital Management CEO Shana Sissel. Also with us this morning is Luke Lloyd. Shana, thanks very much for joining the conversation. I want to ask you about markets here as we look at futures, which have been mixed this morning. The Dow Industrial showing a gain right now at the highs of the morning right now with a gain of 92, but the NASDAQ is lower by 50. S&P 500 exactly where it closed on Friday. Interest rates, meanwhile, way down from the highs of the last year. The 10-year Treasury yield right now sits at a level of 3.64%. That's down 0.6 of a basis point. As the Federal Reserve is about to kick off the two-day monetary policy meeting tomorrow, the widely expected, widely talked about meeting is expected to result in a cut in interest rates on Wednesday by 25 basis points. But the Journal is writing this morning, economists are arguing for a 50 basis point cut, saying it's better to start big with rates so far from neutral and the labor market cooling. JP Morgan Chase CEO Jamie Dimon continues to raise the red flags on an economy that is slowing. He says he would not rule out stagflation as the worst outcome for America's economic futures beyond a recession. As you know, that means slow growth, declining growth, while inflation keeps going higher. He's got a greater confidence that inflation is cooling. Having said that, Shana, how would you assess the current macro story?
Well, I think that if you look at core inflation, especially as it is related to housing, inflation is still over 3%. It's hard for me to justify a 50 basis point cut when you have this problem with core, which takes out all the volatile food and gas kind of prices. And with that said, the Fed is very focused on trying to achieve this soft landing, which is so difficult to do and would be considered a major feat if they're able to achieve it. I just can't foresee them cutting 50 basis points without suggesting to the market that they know something that we don't in terms of the economy, and if they want to ensure that they have enough ammunition to, in the future, potentially cut, have a larger cut. They really do, in my opinion, need to start off at 25 basis points now, because there's no evidence that there's a significant weakness in the economy at the moment. But if there is, they need to be able to have the tools in order to address it. And if you cut too fast, too soon, you don't have those tools.
Yeah, I mean, the Journal is out with this piece. The Fed enters tricky terrain. Rate cuts in a decent economy, basically saying that, look, it could be too late because in Congress back in 1959, Milton Friedman spoke saying that changes in Fed policy are similar to a water tap that you turn on now and that then only starts to run 6, 9, 12, 16 months from now. So is it too late to start cutting rates now? Are we already in a situation where the economy is slowing pretty dramatically with some serious cracks in the labor market? Shana.
I don't think it's too late. That's just my opinion. Of course, you know, Fed policy is backward-looking, and we want to be forward-looking. But the labor market seemed to have normalized. We're still seeing strong consumer sentiment. Retail sales have been pretty steady. There is, as you pointed out, the banks suggesting that consumers are having difficulty paying down on their debts, but that seems to be anecdotal. Overall, I think the economy is doing okay. And as I said, at the end of the day, you need to make sure that the Fed has the tools in their toolkit to cut faster if they need to, and I just don't see the evidence for them to do that now. They can always do an emergency cut if they have to. I just think that going too fast too soon could actually be worse than being measured in their approach.
Yeah, Luke, how do you see it? The Journal also says that the Fed's impending rate cut will do little to close the housing gap, saying affordability remains an issue with home prices near record highs. The cost of home insurance and property taxes are rising as well, Luke.
Well, this goes kind of right along with what you were just talking about. The Federal Reserve is great at two things. They're great at breaking things, and then when they do break things, bailing things out. That's essentially what the Federal Reserve was created for. And when it comes to housing, the Federal Reserve has done a great job at completely breaking the housing market with the quick rise in interest rates, and that they're offsetting that with the ridiculous government spending that's also inflationary. So you have now the situation where we have the most unaffordable housing market in history right now, and the damage has been done. So going forward, things you have to pay attention to is if you go all the way back to 1984, the average house was $78,000. Income was $22,000. The price-to-income ratio was 3.5 back then. Fast forward to 2007, right before the housing crash, median household income was $50,000. The average home was $257,000. That's a 5.1 price-to-income ratio. Right now, price-to-income ratios are 5.3, higher than they were in 2007. So there's three ways that this can go. Either houses have to decline essentially 30% to get back to even an average median line of where they should be, or incomes have to increase 30%, or the Federal Reserve has to basically cut interest rates back to 2%. I don't think any of that's going to happen anytime soon.
All right. Well, look, I just want to say that Tom Lee, who I follow closely and I think has been spot on, says we're going to have tailwinds into the September FOMC. But, of course, September has a peculiar seasonality that we have to pay attention to as well. But all this talk of cuts in rates should keep stocks higher going into this meeting. We'll see. Shana, good to see you. Luke, you're with us all morning, and we appreciate that. Great word on Wall Street, guys. Thank you.